Hi everyone, welcome to the Forex Basic Quickstart program. In this segment, we'll be covering a few topics such as number 1, what is Forex? Number 2, what are pip and pip spread? Number 3, what is a long and short trade? Number 4, candlesticks and candlestick charts. And number 5, basic money management rules. So let's get started immediately. Let's go straight to the first segment. What is the Forex market? Forex, or foreign exchange in short, is the largest financial market in the world. Now just how much does the Forex market trade in a single day? Well, by comparison, the New York Stock Exchange trades about $169 billion in a single day. The Forex market, on the other hand, trades an astounding $5.3 trillion in a single day. Now that's literally over 31 times the size of the New York Stock Exchange. Point number 2. Forex is traded worldwide via an electronic system. It is not traded through any physical exchange. So if you think about it, if you're going to compare the stock market, all stock markets around the world are traded on a centralized exchange system. The Forex market, on the other hand, is not. This is the reason why the Forex market is called an OTC market, or an over-the-counter market. Point number 3. Forex can be traded 24 hours a day, 5 days a week. If you look at the graph that's showing on your screen right now, the world generally is split into 3 regions. The first region, Oceania or Asia, operates at about 5 a.m. to 7 p.m. Europe or London opens their markets at about 3 p.m. to 12 a.m. and the US market opens from about 9 p.m. to 5 a.m. Just by looking at the diagram on your screen, it gives us an impression that the Forex market has to be open 24 hours a day, simply because international trade is going on in every single country at any point of time. Who are the Forex players in the market? Number 1, we have the central banks. Central banks include the Federal Reserve in the United States, the European Central Bank in Europe, Bank Negara in Malaysia, and the Monetary Authority of Singapore. Central banks take part in the Forex market for only one reason, and that is to regulate monetary policies. We next have the commercial banks. Commercial banks like JP Morgan, Merrill Lynch, Royal Bank of Scotland. These banks take part in the Forex market for only one reason, and that is to return a profit. Big importers and exporters also affect the Forex market in their small way. As an example, if we look at big exporters like Sony and Nissan and Toyota in Japan, these players affect the Forex market as well. Hedge funds are much like the commercial banks. They trade the currency market for only one reason, and that is to return a profit for their clients. The next segment includes business travelers and tourists. Whenever someone travels from one country to another, by and large they will exchange their local currency to the currency of choice, which is in the country that they visit. As an example, when someone from Singapore wants to have a holiday in the US, they will exchange their Singapore dollars to United States dollars. When that happens, these travelers and tourists affect the Forex market in their small way. The final group includes individual speculators like you and me. This is a growing group that's happening in the Forex market right now. This group of people trade the Forex market essentially for only one reason, and that is to return a consistent profit over time. Forex involves the buying and selling of different currencies. It is traded in currency pairs. Let me give you 2 examples. The first example is the euro versus the US dollar, and the second example includes the US dollar versus the Japanese yen. There are 7 major currency pairs traded on the Forex market today. Let's explore all 7 of them. The first one is the euro versus the US dollar. We then have the US dollar versus the Japanese yen, the pound sterling versus the US dollar versus the Swiss franc, the US dollar versus the Canadian dollar, the Aussie dollar versus the US dollar, and finally the New Zealand dollar versus the US dollar. Take note that out of the $5.3 trillion traded in a single day, the first pair, which is the euro versus the US dollar, is the one that is most traded worldwide. In fact, out of the $5.3 trillion traded on a single day, the euro-dollar accounts for about 24% of that total volume traded. Now, let's move on to the next segment. What are pip and pip spread? Let's start off with this question. How would you read a Forex price quote? Let me give you an example right now. Let's assume that the current euro-dollar rate is at 1.3510. The currency on the left, which is the euro, is termed as the base currency. The currency on the right, on the other hand, is called the countercurrency. How you would read the quote is that 1 euro is equivalent to 1.3510 US dollars at that point of time. From the price of 1.3510, the currency quote can either go up to 1.3511 or it can come down to 1.3509. When it moves to either 1.3511 or 1.3509, this is called 1 pip of price movement. Pips are essentially used to describe price movement. Let's look at one example right now. If the euro-dollar moves from 1.3510 to 1.3610, how many pips is that? If you had answered 100 pips, you're absolutely right. Let's look at a second example. If the Aussie dollar moves from 1.0647 to 1.0584, how many pips is that? If you had answered 63 pips, you're absolutely right. Take note that from the two examples we discussed, the pips are immaterial of the direction of the Forex market. If we had looked at the first example, we saw that the price of euro-dollar actually went up by 100 pips, and the price for the Aussie dollar in the second example dropped by 63 pips. Let's look at a third example. If the dollar-yen moves from 89.10 to 89.50, how many pips is that? The answer is 40 pips. You would have noticed that for the dollar-yen, the pips are actually quoted to only 2 decimal places. This is true for all the counter-currencies where the Japanese yen occurs in. For an example, the dollar-yen, the euro-yen, the pound-yen, and the Aussie-yen. In this particular instance for the dollar-yen, if it moves from 89.10 to either 89.11 or 89.09, this is considered 1 pip or price movement. However, some brokers have an extra decimal place on the trading platform. As an example, if you see the price for euro-dollar as 1.35102, or if you see the dollar-yen quoted as 89.106, the last decimal place is considered 1 pipette. In this case, it is 0.1 pip. So what is the value of 1 pip? 1 pip is roughly equivalent to 10 US dollars. Take note that this is only an estimated value per standard lot. As an example, if we were to look at the euro-dollar, which has a current price of 1.3510, then 1 euro is equivalent to 1.3510 US dollars. 1 pip equals 0.0001 US dollars multiplied by 100,000, which is the value of 1 standard lot. The answer we arrive at is that 1 pip is equivalent to 10 US dollars per standard lot. What about for cases when it's quoted to only 2 decimal places? Let's have a look at the dollar-yen. Let's assume that the current price for the dollar-yen is at 89.10. In this case, 1 US dollar is equivalent to 89.10 Japanese yen. 1 pip is then 0.01 Japanese yen, multiplied by 100,000. The answer we arrive at is 1,000 Japanese yen per standard lot. To find out how much this is in US dollars, we simply divide 1,000 by 89.10. The answer we get is 11.22 US dollars per standard lot. In summary, whenever the US dollars is quoted as the counter-currency, 1 pip is always equal to 10 US dollars per standard lot. There are 2 prices quoted for each currency pair at any one point in time. Let's have a look. The column on the left is called the bid column, which essentially is the selling price. The column on the right-hand side is called the ask column, and that is the buying price. What is the difference between these 2 columns? Let's have a look at an instance for the euro-dollar. In this example, the sell price for the euro-dollar is at 1.4220, and the buying price is at 1.4222. The pip spread is essentially the ask minus the bid. In that instance, it simply means the buying price minus the sell price, that is 1.4222 minus 1.4220, which gives us the value of 2 pips. This is considered the pip spread for the euro-dollar. As an example, if you buy at 1.4222 and exit immediately at the sell price of 1.4220, you would lose 2 pips. If you sell at 1.4220 and exit immediately at the buy price of 1.4222, you would also lose 2 pips. In summary, the pip spread is always the ask price minus the bid price. Now let's look at another example for the dollar CAD. From the screen, what is the pip spread for the dollar CAD? All we've got to do is take the ask price minus the bid price. From the figure, the answer is 0.9694 minus 0.9691, and the answer we get is 3 pips. Let's move on to the next segment. This segment is called What is a Long and Short Trade? Every Forex trade has an entry price, a stop loss, and at least one take profit level. Let's define what an entry price is. The entry price is essentially the price at which we enter the trade. The stop loss is a predetermined stop loss level, and the take profit is a predetermined profit level. A long trade occurs when we want to buy when we expect prices to go up. Take a look at the diagram on your screen right now. For a long trade, the take profit price is above the entry price, and the stop loss level is below the entry price. A short trade is basically a notion that we want to sell when we expect prices to come down. Based on the schematic on your screen, you would notice that for a short trade, the take profit level is below the entry price, and the stop loss level is located above the entry price. In summary, when we want to buy, it simply means a long trade. When we want to sell, we will execute a short trade. The next segment is called Candlesticks and Candlestick Charts. A price chart that uses candlesticks is called a candlestick chart. This is an example of a candlestick chart. On your screen, you would see 5 examples of candlesticks. The yellow arrow represents the body of the candlestick, and the purple arrow represents the shadow or the wicks of the bodies. Take note that the bodies of the candles can have the 2 representations that you see on your screen right now. Bodies of the candles can have, when they do not show any wicks or if the bodies actually represent just a single line. Candlesticks represent price movements for a period of time. As an example, for the price movement that you see on the left-hand side of your screen, all of that can be represented by just one candlestick. As an example, if the period is for 15 minutes, then the period of 15 minutes movement of the price can be represented by just one candlestick. If the period is 1 hour, then all the prices are essentially condensed into an hour called the hourly candlestick. How do we read a candlestick price? Let's assume that the candle opens at 11 a.m. If the candlestick that we choose is an hourly candlestick, then essentially at 11 a.m. the open price is the price at the start of the time period. Prices will then start to move. The low price is essentially during the 1 hour period. It records the lowest price at which the market moves. During that 1 hour period, again, prices can then hit all the way up high. On the screen, the high price is essentially the highest price during the time period. Because we chose the hourly candle, we assume that prices now close at 12 noon. The closing price is simply the price at the end of the time period. In summary, if the closing price is higher than the opening price, we term this a bull candle. What happens when we look at the bear candle? For a bear candle, the open price simply is the price at the start of the time period. During that period, prices will then start to fluctuate. When prices reach the highest point, it is simply termed the highest price during that time period. And when prices fall to a lower, it is simply termed as the lowest price during that particular time period. Finally, at the close of the time period, prices will then come to a stop. If the closing price is lower than the opening price, we simply term this a bear candle. In summary, what you see on the left-hand side is considered a bullish candle, and what you see on the right-hand side is termed a bearish candle. Take note that the similarity between the two is that they have the same high prices and low prices. The only difference is that for a bull candle, the closing price is higher than the opening price, but for a bearish candle, the closing price is lower than the opening price. Here's something that I wanted to point out. For a bullish candle, take note that the color of the candle represents the background color in your MT4 platform. As an example, if your background color is white, the bullish candle represents the white candle. For the figure on the right, if your bullish candle is black on the MT4 platform, if that is the same color as the background color, that is termed the bullish candle. I hope you enjoyed this video, and let's embark on your journey to Forex profits together.